Hello and welcome to our Professional Practices Focus Group webinar, which is on the subject of top tips for 2026 for finance partners and COFAs in law firms. This one is aimed at law firms. And because we've reached the end of the 2025 season of working with our law firm clients, we thought we'd have a look back at the things that we've seen during that season and just give some tips to partners and COFAs out there so they can be prepared for 2026. The three of us we are partners in three different firms of chartered accountants at three different places across the country. And so I'm very pleased to be joined by Veronique Constantine, who is a partner in Westcotts, which is a firm with offices across Devon and Somerset. And Veronique is based in Plymouth. And John Atkins, who is a partner in Larking Gowen, which is a firm with offices in Norfolk, Suffolk and Essex, and he's based in Norwich. And I'm with the firm Buzzacott, and we're based in central London. As I say, we all work with professional practices and we all have a keen interest in law firms. So we talk to each other quite a lot about things that we see, and we bounce ideas off each other and technical questions and things off each other. So we thought it would be a good thing to share with our audience today. So we're going to think about three separate topics. And the first one I'll kick off with straight away is looking back at the Solicitors Accounts Rules work for 2025, that piece of compliance work that almost all law firms need to have done, and looking at what we saw last year or this year and the changes that we think law firms and COFAs should think about for 2026. So the first thing that I wanted to just mention is I think what I've seen this year is that there needs to be a bit more of a formalised process in some law firms. There's lots of evidence that COFAs are doing the right thing. And we know that the SRA is very keen that COFAs do regular checks on bank reconciliations and that they show that they've signed them off and that they've reviewed them and that sort of thing. And that is happening, which is great. And there's a lot fewer breaches than there were in the old days when so many things were reported to the SRA. It seems that law firms are really taking it incredibly seriously, looking after their clients' money. But I think sometimes what we notice is that there isn't a formalised process in some law firms, and the process is not intended to be a telling off. It's supposed to be a constructive process where the COFA looks at various fee earners' matters during the year and their files and just checks that things are happening properly. So the tips that I would give are for COFAs to look at particular client files during the year, to pick a selection of them from their fee earners and actually conduct a review of them and make it a formalised process that shows the SRA that's actually what they've done. And it's a good idea to pick fee earners or solicitors who are new to the business, who might not know the way that the law firm does things, new clients, significant clients, and have a look at those files and check that everything is being looked after correctly. And document that, because the SRA will be pleased to see that there is a formalised process and that it's been taken seriously. The other thing is that with bank reconciliations, of course, in the old days, bank reconciliations were done and then they were printed out and then they were given to a partner who looked at them, reviewed them and actually signed in pen on the bank reconciliation, and then it was put into a folder somewhere. These days it's all a lot more electronic. So I think what needs to happen in some cases is that there still needs to be a bit more of a formalised process on that to make it clear that the COFA has actually looked at them and checked them and looked at the transactions that happened during the year, unrecorded payments, that sort of thing, and checked that they make sense and sign it off or have an email on file that shows that they've actually been reviewed. But generally speaking, I would say that I think the Solicitors Accounts Rules reviews that we see are much better than they used to be in the old days, and there aren't many significant breaches, and the SRA don't get as many reported to them these days, although there has been a slight uptick, I think, on when the 2019 rules first came in, but things have been being done quite well. I'll hand over to Veronique, because you were going to talk, I think you and John are going to talk a little bit about residual balances and various other areas, aren't you? So I'll hand over to you.
Yeah, sure. I'd echo the same sentiments as you there, Claire, in terms of as processes become more electronic, there is a greater need for actually documentation needing to be improved and in place. And actually, I've seen it not just with bank reconciliations and things like that. It will be down to client interest being calculated, donations to charity, all of those calculations and correspondence where, trying to return those amounts to the client just need to be documented better, and no serious breaches, but just a need for improvements in documentation. And obviously, as we know, the SRA, hot topic of theirs is residual balances, and that's something that has been very topical amongst my clients this year. And actually, I can see a lot of my clients have made improvements throughout the year on year, but there's still more work to be done there. And just a bit of a caveat, one thing that I saw this year in particular is actually looking at historic bank reconciling items, which if the COFA pays a little bit more attention to in this respect, is actually there might be some old items on the bank rec that actually fall under being a residual balance, and the same sort of procedures need to be applied there in terms of making sure that the money is returned promptly. And I know John's going to talk us through a bit more on this, but as we know, there's a current consultation out with the SRA reviewing residual balances in particular and removing the return promptly, and actually bringing in a more definitive time frame as to when client money should be returned. And I know it's been talked about this 12-week period, and I think that will be good in terms of it gives clarity to law firms in terms of knowing what the expectation is there, and just the continued need to demonstrate that appropriate measures have been taken to return client money. So I'll hand over to John just to talk to us a bit more about that.
Thank you, Veronique. So as you've mentioned there, obviously a consultation was launched by the SRA in November 2024. That was closed in February 2025. And just for, I suppose, reminding everyone, there was three key parts to that. One was the model of solicitors holding client money. Secondly, the protecting client money that solicitors do hold. And then thirdly, delivering and paying for a sustainable compensation fund. So those first two obviously touch on a lot of the points that we've discussed today. And then if you go through and read the consultation, then in relation to the residual balances that Veronique's touched upon there, exactly that. Where the 2019 rules, when they came in, they were very principles based rather than rules based. And exactly what is promptly, to which 12 weeks has been defined. And I think when you delve into that, that provides two reconciliation cycles for the 5 weeks current rule to look at those balances, which I think if you stand back, hopefully both of you would probably agree, I think 12 weeks to pick up any residual balances and return them to a client is probably a reasonable period of time, I would say.
I would agree. In fact, John, if I can just jump in, one thing that occurred to me that is that a client of mine recently said, when I said, have you managed to track down this client? And they said, well, we've emailed them, and we've emailed them 4 or 5 times. And I said, actually, email isn't enough. I think a lot of firms need to remember that it's not just, you can't just email a client to try and get them to correspond with you so you can return the money. There's all sorts of ways of getting in touch with them. And there's the phone and there's social media these days, isn't there? So I don't think an email or even several emails is enough. But yeah, sorry to interrupt.
No, leads me nicely on, Claire, to I think Rule 8 would be something then that they probably will have to tweak, which is then actually the holding and ensuring client details are correct. So
yeah,
in the consultation, you've got 12 weeks to return the item, and then potentially another 12 weeks if the client information is out of date. But as you say, in this world that we operate in 2025, then I think not having that client information is a little bit of a weak response, which I think you'd imagine the SRA will stamp down on that as well in Rule 8 as well. Which then, as I say, if you then go back to this principle-based system, then interest on the client account is topical for many different reasons, whether that be from the underlying profitability of a firm, whether it be to tax compliance with HMRC, which I'm sure we'll come on to later. But if you go back to the SRA rules perspective, once again, a fair sum is not defined, to which I think you go through the consultation defining what fair is. We've definitely something that I think they will look to do going forward in that place, and talk of a de minimis limit of interest calculation, whether that be paid to a client or not. It's obviously a huge area of focus at the moment, and I know in some other jurisdictions, then if interest is earned on a client's account for a legal firm, then that money is used to provide free legal services. So that could be something that the SRA may look at going down the line. I suppose linked to that as well, you've got then the alternatives of holding client money, to which third-party managed accounts are the most viable option at the moment, but those are fraught with insufficient number of options within the market, costs, speed of the processing, but I think particularly for the conveyancing sector as well, if it got to Friday afternoon and 4 o'clock and you're trying to get the funds and the third party is closed, then I can't say that's going to be a great legal service being provided. Like you say, I think client interest is the one that everyone's focused on due to the profitability and obviously where we're at the moment and in the economy and the budget that's coming down the line as well. But I do think hopefully if you stand back and look at the SRA, I think providing a little bit more of a rules-based system or better definitions then will hopefully give people that ability to comply.
Yes, agreed. Yes, I think the interest factor, we've certainly seen a few clients this year where the interest that they earned was huge compared to previous years. And you do wonder when interest rates start to fall further, which I assume they will do, then whether that's going to affect them. I'm also not seeing many or any clients that are using third-party managed accounts. Are you guys seeing anybody use them? No. No, it's something that really doesn't seem to have taken off in a big way for the reasons you're saying, John. Okay, let's move away from the Solicitors Accounts Rules and look at sort of general financial management issues and our recommendations for Q4, which I suppose is what a lot of law firms are going to be in soon after Christmas, and the 2026-27 financial year ahead. Now, John, I know you talk to your clients a lot about the VAT partial exemption matter. Do you want to kick off with that?
Sure.
Because it is so important, isn't it?
Yeah, I think as you say, I think from where we've looked at it, it probably impacts medium-sized firms, I would say most. I think for a smaller sized firm, which we can come on to some of the detail in due course, and the larger firms, then the percentage of their total income and net profit that is derived from client account interest is probably a smaller percentage than medium-sized firms, to which I think we've seen probably somewhere between 15 to 20% of net profit being the net client interest earned on the client's account, which then, as you say, this has been a huge area of focus, particularly with HMRC continuing to clarify their stance in this area, primarily through inspections at the moment. So we've obviously talked about it from the SRA's perspective, but it has, in relation to VAT, it has an impact on the recovery of input VAT that the law firm can recover. If we just take a step back, the issue arises due to legal services being a taxable supply and the client account interest being an exempt supply and not an incidental financial transaction, therefore outside of the scope. So we then go through the input tax recovery and the partial exemption calculation. So as I said, if you take a step through it, when we look at total client interest, which generally I'd say maybe 5 to 10% is what we see. I don't know if that's what across your client bases as well.
Yeah, that rings true with me. Yeah.
Sounds about right. Yeah.
So when you obviously then that is 5% it's not an incidental number, and it's probably a lot greater than the 0.1% we saw maybe in 2019 or something along those lines. So when we look at the input tax split and then breaking it down between taxable, exempt, and the remainder being the pot, it's the input tax on the pot that is the key assumption that HMRC are looking at the moment. With regards to the input tax recovery, we've got the de minimis limit of £7,500. So if we work backwards, if you're a small size firm and you've got 5% of total income was client interest, then your input tax, assuming everything was in the pot, would need to be in excess of £150,000 to breach the de minimis 7,500, which I think probably for most 2 to 3 partner firms, you probably agree it's quite difficult to get over that £150,000 of input VAT, particularly where people costs are probably somewhere between 35 and 50% of total costs anyway, and they're outside the scope of VAT. So it's say the medium-sized firms where you've probably got £5 to £10 million worth of turnover, where their input VAT as well is probably in the 400,000s, maybe, depending on the number of offices that they've got. So they're the ones that there needs to be real focus at the moment. And with regards to the calculation of the potentially input VAT recoverable, then there's 2 different thoughts that people are looking at the moment, where you've got a client with 1 office, potentially all of the input tax would then fall within the pot. If you've got a client with multiple offices, then there's a narrower view that you would only put into the pot the input tax recovered on the office where the treasury function is, which would have a significant impact on the calculation of that irrecoverable VAT. So that's something that we've been looking at with clients at the moment. But once you do look at it with a client, and if you calculate that potential provision, I think the key things is if you then book that within the accounts, if HMRC were to do a visit later down the line, then by having that, booking that provision within the accounts, I suppose you're opening up more of a risk with HMRC, is they would probably perceive that you knew at that point in time you hadn't calculated the correct and paid over to them the correct level of input VAT, even though you've made the provision and been prudent within the account. So I think key takeaways are, there's one thing actually looking and calculating the provision, whether that be for 2025 or 2024 or maybe earlier. And then if you do book a provision, then the impact that has on your risk with HMRC going forward.
Yes, and I think firms that use software systems like Xero and QuickBooks and some of the bespoke ones for law firms need to just make sure that those systems are capable of detecting that as well, because they might not always take into account that particular rule. Okay, thank you. Now, when we put this together, we had a little chat beforehand, the three of us, and we weren't particularly going to talk about tax because we don't class ourselves personally as now tax experts. We have others in our respective teams who do that sort of thing. But we can't really ignore the elephant in the room, which is that there has been a lot of talk about whether there's going to be some kind of employer's national insurance style tax imposed on LLPs. And at the moment, it is just speculation. And of course, just very recently, Rachel Reeves has been talking about, she hasn't been talking about it, she's been alluding to the fact that she may simply raise income tax and national insurance on everyone. Apparently, we all have to play our part, was the phrase that I heard she used. So I have to wait until the 26th of November to see what she comes up with. But there is still that possibility, which has been raised before, that there might be some kind of tax on LLPs. And so how would that look? It's very difficult to tell, but it looks like it would only affect LLPs. It looks like that might be to try and divert attention away from it affecting doctors, because they tend not to be in an LLP. They tend to be more unincorporated partnerships or even limited companies. And we don't know the rate, but taking into account all other rates that are impacted by it, it might be a sort of equivalent rate of about 7%, maybe up as high as 10% that could be applied on LLPs. When would it come in? Again, nobody really knows, but there probably is time for it to come in by the 6th of April 2026, which would be very soon. And so what would LLPs do? What would law firms do if it affected them? Because although there is an argument, I suppose, to say that it's imposing some level of fairness on some LLP law practices, accountancy practices, where the partners are earning really huge sums of money, it is an unfair thing to do on some much smaller practices where they're really not earning that. The profit share that they're taking home is really not that great. And of course, unincorporated partnerships, so far as we understand, would not be affected by it. So would it mean that LLPs go back to being 1890 partnerships? And this sort of rather makes me smile, because when I first started my career, I spent 25 years helping unincorporated partnerships become LLPs. Am I going to spend the rest of my career helping them come back out of that and become 1890 partnerships again? I don't know, but that is one possibility. Would they convert to a limited company? Although that's a much more clunky prospect for some law firms, and I'm not sure that there's a great deal of a tax saving, notwithstanding we don't know what's going to happen on the 26th of November. There is also talk that for some bigger practices, would they just move their main office to another lower tax jurisdiction? And I think we've all read in the press that Dubai seems to be the one that some of the bigger law firms are looking at. Or do they stay as they are? They stay as they are and simply put their fees up. And some firms might be able to do that. Some professional practices may be able to do that. Some law firms, some accountants may be able to do that to a certain extent. We look after a lot of architects as well, and I don't think they would be able to do that. So we really don't know much more than that, I'm afraid. We're all watching and waiting to hear the latest. So I would just say we just have to keep calm until the 26th of November and see what happens. But of course, if this does happen, then it's going to have a huge impact on cash flow, which was a topic that Veronique wanted to talk about anyway. So it's a good segue into the subject of cash flow, Veronique.
Yeah, I think obviously tax is such a topical subject, isn't it? And it wasn't so long ago we had the change in tax basis, which actually now with all budget talks is a bit of a distant memory, but it still wasn't that long ago. And actually with the change in tax basis, what was really clear from that was actually having really important, up-to-date, accurate management accounts with profit forecasts and accurate cash flow planning. And actually just looking at the amount of drawing levels and what was available to take out the LLP or the business. And that continues to be the case in terms of tax planning and making sure that there is enough cash available to make those tax payments, although we might not know what they might be at this time, but and getting tax reserving. And that's a lot of advisory work that I've done for my clients over the last year, is looking at partner capital balances. And it was after the change in tax basis, because obviously the demand on cash flow, it was just making sure that partner capital balances were at the right level, especially since a lot of businesses have grown, and also just dealing with succession with new incoming partners and exiting partners, which I'll talk about again in a minute. But it's just the demand on cash, and as we know, cash is king. And that continues to be an important part that we will continue to advise on. In terms of giving advice on management accounts and management reporting, I've got involved with a lot of clients looking at what they're actually including in their management accounts reports, and whether that's looking at efficiencies and improving those efficiencies and the key performance indicators, looking at staff utilisation and recovery rates, and just helping to give a bit of focus that actually if you tweak small little things, that they can make a big difference to your management accounts, and getting partners to focus on those, that will actually have quite a dramatic impact on the bottom profit. And as we know, just continued WIP management, so work in progress, it's the most significant balance or estimate in the management accounts, and just getting partners into good routine of reviewing WIP regularly and diligently, and making sure those adjustments and reviews are done on a regular basis rather than leaving it to the end of the year. So actually, as a business, you know exactly where you are.
Thank you. Yes, I always think lockup is one of those things. I think the three of us probably talk to our clients and tell them you must keep an eye on lockup and make sure, because you can get money coming into your bank account much more easily if you keep an eye on your lockup. But do we do the same with our own clients, I wonder? I won't ask you to answer that.
Just one point you mentioned there, Veronique, and I was just thinking it through. Like you say, obviously we've got the budget coming on the 26th of November, and we've had basis period reform. So with the spreading of profits, then if there was an increase in income tax and you took the LLP employers' national insurance to one side, then obviously those profits that are then unwinding over the remainder of the time at a higher income tax rate as well, potentially.
No, the budget's going to be an interesting one in terms of what it opens up, and actually all the effects it has that might not be initially thought through. But
yeah, it really is. Okay, we're almost at the end, but we wanted to leave you with some thoughts of things that you might need to consider or might want to consider in 2026. And John, do you want to kick off with your sort of final thoughts for our audience?
I think we've talked about the budget and tax a huge amount, and just kind of listening to everything that's been said. When accurate budget and looking at a reasonable period into the future and really accurate management information is so invaluable at this point in time. We saw last year with the employers' national insurance, and I think there was probably some people who calculated the impact that had instantaneously whilst the budget was going on, and then there's some who are quite a little bit slower to react, and then have seen that starting to flow through in the numbers now. So I think for me, it'd just be accurate forecast going forward that you can tweak, you can update as soon as what is going on in the economy and the budget, and then hoping that, like you say, having that and linking that back to probably succession, which is probably something that we all touch upon as well, isn't it?
Absolutely. I was going to mention that one thing that I'm noticing that clients are talking to me about, which they never did previously for quite obvious reasons, is the topic of AI. And I'm not an authority on AI, and I'm not somebody who says that all our jobs are going to be taken by AI in the immediate future, but it is something that clients are talking to me about. And whereas in the past they used to say to me, how much should we be spending as a percentage of our total expenditure on, for example, marketing? That was quite a common question I used to get. Now they're saying, how much should we be spending on AI? And I don't have a definitive answer, but it's something that almost all my clients are looking at. We are, I'm sure Veronique and John's firms both are as well. And I think if it's not on the agenda, it needs to be on the agenda, because even those firms that aren't going to be using AI in a big way, they're going to have to start competing with firms that are. And I know from our practice, we are seeing certain AI tricks that are making our work simpler. and it's taking away some of the laborious stuff that we used to do as part of an audit, for example, and doing it much more quickly. I think I'm going to get lots more questions on AI, and it's actually one of the things that I want to look into a bit more next year, just to get more of an understanding of how it affects law firms. Yes, that's something that I would say is on the agenda for 2026. How about you, Veronique?
I agree with you, Claire, because it was only actually the latter end of last week I took a phone call from a prospective client talking about needing to spend more on IT and AI and what that means to them. So it is very much looking forward. And I'd just echo John's points in terms of succession planning, and added to that, just looking at whether there is the right structure in place, especially with incoming and exiting partners. And that is going to be a topic that we're going to discuss next time. But especially in the Devon markets, and I don't know whether you guys have seen it yourself, but there's definitely been a bit more of an appetite for mergers and acquisitions, just because of just trying to recruit talent at the right level, and which is all linked to succession. And I think when we think about succession, we naturally think about the bigger picture, which obviously is really important in terms of looking at long-term strategy. But I think it's just leaving a reminder here is actually just to remember about those internal teams that you've got as well, and thinking about succession for those. And one being the finance team and the legal cashiers, because we know what a scarce supply they are, and good ones are rare. And they're a certain breed which we would all want in our firm in terms of being diligent and having a strong presence and being confident and very knowledgeable about the SRA rules. So it's just thinking about what planning are you putting in place for succession, whether that's within your internal finance team, but also just firm-wide.
Yeah, it's a very good point. I think they're like gold dust these days, good legal cashiers. They're very hard to find. So when you do find them, you want to keep hold of them. Thank you both very much for that. As Veronique said, we have another topic in mind, which will be in January, and it'll be on fixed share and equity partners and what new self-employed partners need to know, which we're doing at that sort of time of year because we assume that's when most people are going to be promoted to partner, and from the 1st of April onwards. So look out for that. Thank you very much for joining us today, and we hope to see you at the next one.